Before the new trading week begins, think about what the next weekly candlestick is going to do. Is it most likely to go higher? Is it most likely to go lower? We are not trying to predict its closing price. We just want to know if it's most likely to go higher or lower. Factors that will impact the weekly candle. Seasonal tendencies. Interest rates. Earning seasons and the release of quarterly earnings reports. Price action on a weekly and daily chart. All of these factors will give you an expectation for that weekly candlestick. Is it most likely to go higher? Is it most likely to go lower? When it comes to price action on the weekly chart, ask yourself this question. What is the market most likely to draw towards? In example, is there an imbalance higher? Or is there a liquidity pool lower? This sets the initial bias for the week. When it comes to price action on the daily chart, ask yourself this question. Where are the liquidity pools price can seek? Following the assumption of the weekly chart, the draw on liquidity for the most part is found on the daily chart. The daily chart should have the majority of your time and analysis. The daily chart will give you feedback every 24 hours on that weekly candle. We use that feedback to support our assumptions of the weekly candle expanding higher or lower. How to determine draw on liquidity. The draw on liquidity will be A. An liquidity pool. B. An imbalance. Large funds and institutions will be looking at A and B on the higher time frames. Inducing liquidity for longs in the market. Induce, succeed in persuading or influencing someone to do something. Inducements build liquidity in the market. Step 1. Market fakes out traders in order to trap them. Step 2. Trapped traders will then place their stops below the marketplace. This is the building of liquidity. Step 3. IPDA then seeks the induced liquidity to bring the market higher. Every time we expect a significant move lower, anticipate a stop hunt in the market. Once step 3 occurs, we want to jump into the lower time frames to look for a specific entry. We are looking for a specific signature in price that shows us the market wants to move higher. That specific signature is an FVG, and that's where we take the entry. For finding a price exit, we need to understand the liquidity matrix. Define the price range before the setup was formed. What is the key high and key low relative to where price is currently now? This is how you delineate a premium market versus discount market liquidity FVG bullish scenario. If the market is in discount, we expect a buy program to occur. This is where our entry formed. We want to find a counter level in a premium market to cover our short entry. This is where our exit will be. We can use the following levels as exits. 1. Liquidity. 2. FVG.